I think crypto has really gone mainstream. It's crossed the chasm. It's no longer this crazy idea. When you have 150 advisors in a room out of 170 saying they own it, when you have Charles Schwab posting videos on X saying maybe between 2 and 7% of your portfolio,
Yeah.
when you have Morgan Stanley launching their own Bitcoin ETF with their name on it, something that they've done very rarely in the past. Look, I think the wave of institutional capital that's going to come into the space is going to be extraordinary. And based on what I'm seeing in the field, it's really starting to accelerate.
150 out of 170 advisors own Bitcoin personally. That's not a niche anymore. That's a mainstream asset class. And according to Matt Hougan of Bitwise, the client money hasn't even followed yet. That wave is still coming. Stay to the end of this one because it gets even more interesting. Hit subscribe so you don't miss what's next, because this conversation only gets better from here.
That was very true prior to the launch of Bitcoin ETFs in January 2024.
Yeah.
I think everyone who wanted exposure would gain proxy exposure, most through something like strategy, some through GBTC, which was that sort of closed-end fund type structure that traded at premiums and discounts, some through Coinbase stock, but they were looking for that proxy exposure. Since the Bitcoin ETFs launched, they've become the easy button for these advisors to gain exposure. Let's just use these ETFs. They're low cost and simple. You, of course, still see people buying strategy stock, but it's now seen as a levered play on Bitcoin, right? That's how they think of it. But yeah, really the floodgates have opened since those ETFs launched.
And would you say that the platforms themselves are also more open-minded to the fund issuers specifically? Because that was one of the things that we encountered was that even with ETFs, they weren't like approved or on the shelf, and so they were limited in what they could own. So I'm wondering if attitudes have changed, not just at the advisor level, but at the institutional level too.
It's such a good point, because just when an ETF launches, that doesn't mean everyone can buy it. It means my uncle can buy it, but it doesn't mean that a Wells Fargo advisor can buy it, or someone at LPL can buy it, or at any other major platform. There's a second approval that needs to take place at these large wealth platforms. And those really started turning on at the end of last year. I would say the second half of last year is when those platforms went from blocking people to allowing them to allocate. Now I would say the market is roughly 85% open. Most of those platforms are open to it, but that means we haven't yet really seen the pickup in flows that we're going to get. Right, and the other thing I've shared in the past, which is true, at least at one point in Bitwise's journey, our average client met with us 8 times before they allocated, which is a painful way to build the business. But I think
people meet fewer times before getting married.
It's true. It's true.
In some cultures.
But it does speak to what you said, which is, when you turn on these ETFs, many people start learning about them, and they don't buy them immediately. So these large platforms that just opened up access, those advisors are on their first or second or third meeting with Bitwise or BlackRock or one of our other competitors, and they're going through this education process. So, this always takes longer than crypto wants, but the tide is always bigger than crypto thinks. And I think that's what you're going to see here, is you're going to see really significant flows, but they will, you're just starting to get a little peek of what that feels like. We haven't felt the full brunt of it yet. I think it's actually one of the few occasions in crypto's history where the fundamentals have been ahead of the price. Often in crypto.
That's a very, very good point.
Yeah, we hype things so much that the price runs ahead of the fundamentals. So it's actually really, really nice to see. I think there are multiple explanations for it. There's never just one. One is that this is just the natural cascade. Most of us in crypto came in through Bitcoin, and then it took us a while to learn about Ethereum and DeFi and other assets.
Yeah.
And I think that story is just repeating. Right. So if people started coming into this market new when the ETFs launched 2 years ago, they're just on this journey where they learn about these other assets, just like all of us did. It's just we forget that we went through that journey. So I think that's fairly standard. The other one was one you hinted at, which is that crypto hasn't done a good job until recently explaining why these platforms have a lot of value. Right. We didn't really settle on this stablecoin and tokenization use case for things like Ethereum, we had all these weird words that were hard for people to understand,
Yeah.
like the world computer, which I don't even know really what a world computer means. It like sounds like the cloud. It's like a little confusing. So I think we've just arrived at this narrative. For what it's worth, Bitcoin suffered the same thing, right? Remember, it was peer-to-peer cash payments.
Yeah.
That was the meta in the beginning.
Yeah.
And it didn't really hit the institutional community until we came onto this digital gold thesis, the store of value thesis. I think Ethereum and Solana are getting there. But as an investor, I love the opportunity to find these entry prices, given the growth we've seen in fundamentals. I mean, just last week, Meta announced it's going to start paying creators using stablecoins over the Solana and Polygon blockchains.
Yeah.
That's a massive potential piece of news. Solana and Polygon didn't budge, right? When the market ignores really big news, that can be opportunity for investors. The question is whether if you hold a stablecoin, which is just a digital dollar on the blockchain, can you gain interest on it the same way you do as if you hold $1 in your bank account? Now, we'll ignore for the moment that most US bank accounts actually don't pay interest. But theoretically, the idea was, could you have a stable coin that would earn interest? Because the stable coin, of course, is backed by a US Treasury instrument, which pays the risk-free rate, let's call it 4%. Can that 4% flow down to the individual holding a stable coin? The banking lobby flipped out about this because if you had a choice between having a checking account that pays low interest and has high fees and has some element of risk because banks can go under, or a stablecoin that is backed by a US Treasury instrument that pays 4% interest, the banking lobby was worried that everyone was going to favor the stablecoins, particularly during periods of stress when you have bank failures in the US and companies going under. So they tried to hobble that in this Clarity Act by making it very difficult for that interest to flow downhill to the end investor. Now, to me, that's anti-consumer. It's my money, I should earn interest. But the banks wanted to restrict that because they wanted to protect their competitive advantage. What the breakthrough was yesterday was sort of a complex 1 foot in, 1 foot out, which said that you can't earn interest just for having stable coins sit in an account. But if you do something with those stable coins, if you spend them, if you stake them, if you take an activity with them, then you can earn interest or income on that. So in the same way that we earn points when we spend with a credit card on an airline, if you spend with stable coins, maybe you can earn some version of interest. I think it's woolly enough language that it will allow significant growth for stable coins to provide this kind of yield. I think that's why you're seeing Circle, which is the largest stablecoin issuer in the US, react positively to the news because it's seen as a growth catalyst for this market. So I'll count it as like a 60-40 win for crypto, and feel pretty good about it. Importantly, if you're a TradFi investor thinking about investing in this space and you're worried that the regulations might shift 180 in 2 years, how much are you going to invest? Right? Once we have that stability of having legislation, which is very hard to undo, that's when you'll see the sort of flood of investment, because that's when the banks will feel comfortable that the rules on the field won't shift. So I do think it's if we can get this bill passed through Congress, which remember it's Washington D.C., so anything could happen.
Yeah.
You should err on the side of expecting sort of incompetence. But if it can get passed, I think it will be a major catalyst for crypto. I think it will sort of help set off a very strong second half of the year. And you think stablecoins are going to be huge, right? People say we're going to go from $300 billion to $4 trillion in assets in the next 4 years. That's the bullish scenario in Citigroup's stablecoin report. That's like 13x growth. That's massive. Where will that benefit flow through to? Will it go to Ethereum and Solana, which are the two platforms on which those trade? Will it go to DeFi assets, which people can use stablecoins on, so protocols like Aave? Will it go to companies like Circle that are building stablecoins? Will it go to firms like PayPal that are experimenting with stablecoins? The answer is it's hard to know. So one way to play 13x growth is to make sure you have exposure to all of those things. And that's what I hear a lot of investors telling us is they want to own both the equities and the assets because they want to own the space as a starting point.
This is one of the clearest pictures I've seen of where institutional crypto adoption actually stands right now. Not where the hype says it is, but where the data says it is. 150 advisors owning Bitcoin personally before their clients. Platforms that only opened access 6 months ago. A stablecoin market that could 13x in 4 years. The wave hasn't hit the shore yet, but it's visible. If you're paying attention to where smart money is moving, this episode was essential. Drop a comment. Do you think the Clarity Act passes this year, and does it actually move markets? And if you haven't already, subscribe because we're covering this space as it happens.